employing your spouse. Do any of you have your spouse or children working for you in your practice? And whether they work for you at the practice or at home, you should consider putting them on the payroll. So one area here has to do with the child and dependent care credit. In order to get that credit, both spouses have to be working. That credit could be up to $1,050 per child. This is assuming your child is age 13 or younger. It could be up to $2,100. A lot of people don't realize that. Can't tell you how many times I meet with a young couple, maybe even not such a young couple, but they have younger children. The spouse has been working in the practice forever. They never put the spouse on payroll. Big mistake. Number one, the travel expenses for that spouse, business related, could be deductible. Number two, we have things like the child dependent care credit. You can take advantage of that if they're on the payroll. The other big thing, which I may not have mentioned before, if you have a retirement plan in your practice and you're limited to putting in $60,000 a year, let's say, well, if your spouse gets paid enough money, they could put $60,000 into that plan as well, so you can actually double the benefit you're going to contribute to the family related to that pension plan. So if you're paying your spouse $20,000 a year to be your office manager and bookkeeper, big mistake, right? Because if you could put them on payroll for, let's say, $70,000, $80,000, and they could fully fund their 401k profit sharing plan, and it works even more attractive, you get even bigger benefit if you have a cash balance plan. So employing your spouse is a great idea. Working with your spouse in your own office, that's a whole different story. Me personally, I couldn't do it, but that's just me. Just joking. Not really. All right, nobody laughs at my bad jokes. I'm going to stop making jokes, especially at my wife's expense. Okay, so paying your spouse, I already covered this advantage. Covered the retirement plan advantage. You could double retirement plan contributions by having them participate in the retirement plan. What about paying your children? Now, paying your children is a wonderful thing. Why? Because if they're not working for you, guess what? You're going to have to support them anyway, right? So I'm a big believer. I did this with my 3 children at a very young age. I got them to work in my office. By putting them to work in my office, I actually paid them. They learned the value of $1. They actually saw that money. They became responsible. The toughest part was getting them to show up to work, but eventually that worked its way out, worked its way through. At the end of the day, by putting your children to work in your practice, the first advantage is you're not just giving them money for no good reason, but they're working for it. They're learning the value of $1. They're now learning to save money. They become a little more responsible and money savvy. Based on the current tax law, your child could earn $12,950 and pay 0 federal income tax. That's a big deal. In my case, I have 3 children. They started working at an early age, but assuming you have 3 children working for you, multiply 13,000 by 3, that times 50% is going to be a tax savings, right? Because in your tax bracket, you're losing 50% on the dollar. Your child may be in a 0% tax bracket. If you're not taking advantage of this, again, you're leaving money on the table. But again, you cannot make up a fiction, right? You can't say my child works for me and they don't. If your child is coming to your office, they could be stuffing envelopes, they could be doing filing, they could be helping you with your internet, your website. They could even be working at home, doing administrative work remotely. It doesn't matter. As long as they're gainfully employed and working for you, you got to treat them like every other employee. You could put them on the payroll. Huge tax savings to you, tax-free income to your child. You starting to understand why I'm talking about a game of chess here? Yes? No, they could be any age, but if your child is already working elsewhere and making a lot of money, then obviously this is going to get added to what their income is. Still an advantage, because if you're in a much higher tax bracket and they're a lower tax bracket, net, you should still come out ahead of the game. And my next slide is going to talk a little bit about that. Okay, so in addition to that, if you're a family limited partnership, or you're an LLC or sole proprietorship, if your children are under the age of 18 and you're paying them, you also avoid paying Social Security and Medicare tax. There's an exemption that they're not subject to that. So if you have a 14, 15, 16-year-old child, let's get them to work in your practice. Every penny you're giving them will be tax-free up to that threshold, and you don't even pay that tax. The FUTA tax, there's all these wonderful taxes, SUTA, FUTA, hearing all these wonderful abbreviations. You could avoid that tax all the way up to age 21. So again, if your tax advisor is not asking you how many children you have, do they work for you, would you like them to work for you, here's why I think they should work for you, then you're not taking advantage of these laws. So the question is, what do you do with your young children that just got paid a good amount of money to work for you? Well, we know what your child wants to do, right? They want to use that money to buy video games or maybe buy some fancy sneakers, but that's not what we're going to do with that money. What you're going to do with your children is you're going to tell them, because you're still their parents, the money you're going to pay them is going to get deposited directly into an account in their own name. Assuming they're under the age of 18, you're still their guardian. What you're going to do is make sure $2,000 of that money goes into a Coverdale Educational Savings Account. That's the maximum you can contribute to a Coverdale Educational Savings Account. Unfortunately, you, the dentist that is successful, if you're married making over $220,000 a year, you're not eligible to do a COVID educational savings account. But guess what? Your child will only make $13,000, $14,000, or $15,000. They are eligible. Again, we're taking advantage of this. The nice thing with money that goes into a Coverdale account, every penny you earn on that will be tax-free that they earn. They could use that money for elementary school, high school, college, etc. So this is all about college savings program. Why not do college savings program in tax-deductible dollars? Taking it to the next step, and this is something I did for my children the whole time they worked for me. Truthfully, I'm still doing it for them, but that's another story for another day. You could put away $6,000 a year of their own money into a Roth IRA account. You say, why would I put money into a retirement account for my 14, 15, 16, 17-year-old? Well, the reason is you're going to put that money into that retirement account with them starting so early and the power of compounding, chapter 12 of my book, that money by the time they retire will probably be worth $1 million. So you're ensuring that they're going to have a very, very comfortable retirement. But let's say for a minute you're not that wealthy and you're not really in a position to let them keep that money for their retirement. They're allowed to pull that money out to pay for their college education. So believe it or not, a Roth IRA that's established by a child could also be used as an educational funding tool. So they put their $6,000 a year into their Roth. Let's say they do it for 10 years. It's now worth, they put in $60,000 for the money you paid them, and you already got a tax break for it. Now it's worth $120,000. They take out $40,000 a year for 3 years to cover their education. The money they put in comes out tax-free. The money they earned is subject to tax, but it's subject to tax at their tax rate, which is extremely low. And the 10% penalty you normally get for pulling money out of a retirement account before the age of 59 and a half, it doesn't apply. One of the exceptions to the penalty for withdrawing money from a retirement account is if you're using that money for higher education. These are the strategies. Again, put them to work. You save a couple hundred here, a couple hundred there, a couple $100,000 there. At the end of your career, we're talking millions of dollars that you're going to have rather than the government. Okay, so I'm going to skip over, I'm not going to skip over this. Let's talk about college-aged children. I remember doing a study club, a dental study club, somewhere out in New Jersey. This was, memory serves me right, probably about 8 or 9 years ago. I was talking about these strategies, and at the end of the lecture, one of the dentists came up to me and said, John, I heard your lecture. My daughter, she's going to NYU. It's costing her a fortune. Of course, I'm paying for it all out of pocket. And my daughter works for me on the weekends when he has free time, whenever there's breaks, she works for me. I said, great, how much you paying her? He said, well, I never put her on payroll. Big mistake. Why? Because the parent, you're making the big bucks, right? So you're not going to qualify for the educational tax credits, such as the American Opportunity Tax Credit, which is $2,500, learning credit, lifetime learning credit, which is $2,000 per year. But guess what? Your child could earn up to $35,500 this year. After getting that credit, their federal income tax bill will be zero. So you could employ your child to work in your practice and pay them a very good salary, especially if they're working in the area of dentistry, helping you out in that capacity. Why not pay them the most you can? It's got to be reasonable compensation, but this alone, let's say it's $35,000, half of $35,000, we're talking 17, 18, about 18, 19,000, let's call it $18,000 in savings on that alone, and your child is getting it all income tax free.